Well, it's a pleasure to be here, and thank you all for staying. I know it is. This is the final panel between us and some cocktails and networking, so we will try to make it lively. And as you have been doing all day, encourage you to vote up people's questions if mine are not entertaining enough or insightful enough, which is highly probable. So without further ado, I'd like to introduce our four contestants for this last for this last panel. Jason, Corey, Jordan, and Mallory, all from the companies that you can see in front of you, and they will all come up and sit on stage and tell us a little bit about themselves and the companies that they represent and have founded. No one wants to sit close to me. Thanks, guys. That's good. Oh, I see. We've matched ourselves. Okay, that's excellent. So, you know what? Let's randomly start then. Jordan, why don't we start with you? You could tell us a little bit about yourself and Nudge Rewards.
Awesome. So pleasure to be here with everyone today. So Nudge Rewards, we built a business that helps retailers more effectively communicate with frontline staff to drive sales. So we fundamentally believe that the way that retailers and food service organizations communicate with the front line is entirely flawed. And as a result, each and every single frontline staff doesn't necessarily have all the information that they need to do a great job. So we built a mobile software that allows these brands to connect with the front line through a mobile application. Background on myself, worked in the retail industry for close to 10 years, helped build a company that was acquired by Loyalty One. From there, then launched a business called Carrot, which partners with the government to incentivize Canadian citizens to engage in different government programs. Left that business and started Nudge with a couple of others. So looking forward to sharing a little bit more.
Fantastic. Mallory, why don't you give us a snippet on Bridget?
Perfect. So Mallory Brody, CEO and co-founder of Bridget, started the company back in 2013. We were a Next 36 company, and my business partner Lauren and I grew up in the construction industry, had families in construction. She's a civil structural engineer, and so decided to focus on that industry and start building a mobile app for the team in the field. Specifically, we focus on something called punch list management or deficiency management. And it's essentially what QA is to the software world, we are to large-scale construction sites. So it's ultimately issue tracking and trying to get that resolution before the project is complete. Started it right during our fourth year at Western University, and now based in Kitchener, Ontario, with a team of 30 people.
Okay, we've got one remaining soldier. Oh, sorry. Yeah. Go ahead, Corey. Give it to us.
I'm Corey Gross. I'm the founder and CEO of a company called Sensible. We're just based down the street at Adelaide and Spadina here in Toronto. We work with large banks in Canada, the US, UK, Australia, and now Ireland, helping banking customers capture and manage their item level receipts. And if you're a small business, we automatically match those receipts to your transaction history so that you can get a very detailed view of your financial activity. And also for everyday personal banking customers, we allow them to use those receipts to inform personal financial management goals and also to keep track of them for returns, warranties, exchanges, all the rest of it. We were founded back in 2013 out of the Digital Media Zone, which is at Yonge and Dundas, which is a incubator for early stage companies, and have since grown to 62 people. And so very excited to talk to you here today.
Great. And Jason?
Thanks. My name is Jason Tham, and I'm the CEO and co-founder of Nulogy. We're focused on building a platform that connects CPG brands with their manufacturers to launch products and to dramatically reduce waste in global supply chains. So if you think of many products that you and I consume on a daily basis, from shampoo to cosmetics from L'Oreal, or medication, or Lindt chocolates in eating, we're in those supply chains where a lot of those brands launch products and they don't make them themselves. So we drive efficiencies and streamline that process to be able to launch those products. Brief background on myself, engineer by background in Waterloo, started with, and all the co-founders are all four of us at the company, all from Waterloo. I worked at Kellogg's in supply chain and manufacturing, and also was a software developer helping grow a company. Helped take it, went public, 300 people, now it's about 1,000 people, then we started this company, and we're about 150 people today, downtown offices in Toronto as well, and looking forward to
Beautiful.
the panel.
Thank you. So you can see we have a variety of entrepreneurs in front of us, a variety of executive officers in front of us, and the definition is around growth capital. And so just to sort of set the framework for a moment, because growth capital could mean a lot of things to different people. We at Relay sort of look at it in three buckets. There's, kind of angel financing, which could be, let's call it sub 500,000 or sub $1 million. There's seed financing, which would be, anywhere between, call it $1 and $3 million or 2 million and sub 2 million. And then you've got growth capital. It's such a humongous category. Which could mean a $5 to $7 million investment, it could mean a $2 to $3 million investment, and it could mean a $25 or $30 million investment. So I think just to set the expectation and set the stage, so to speak, you will get a whole variety of opinions and points of view on raising capital. And the companies that these individuals run probably range anywhere from, at the smallest, 20 or 25 people to, up to 150 people, with offices likely starting in Toronto and then spreading themselves globally, just based on the needs of their customers and or where there is R&D needs or various and other sundry requirements for the business. So that just wanted to set that expectation. So the first question, just again to get everybody acquainted here, if you guys could all talk about when you raised your last round of financing and how long it took. Two very simple questions. Mallory, why don't we start with you and we'll go my left to right.
For sure. So our last round of financing would have been like January, February 2016. That actually came together very quickly, so it probably took 2 months to put that together, and it sort of overlapped the Christmas holidays, so got it done pretty quickly. And ultimately, that was because it was kind of off the back of a convertible note round that we had done. So it was a $500K round, roughly, that we had done with earlier investors. And then as soon as we closed that, we got a term sheet the next day, because the VC that we were speaking with, wasn't quite ready to make a move, and then they saw that deal close, and then they wanted to kind of start a new round off. So that was a $2.2 million round, and the intention really around that was revenue growth, of course, and really doubling down on the product development. So up until then, we only had 2 software engineers on the team, so it was a relatively small team, and for so long, we had just felt like we knew exactly what to build, but we just needed more bandwidth to get it out to our customers. And so from there, we now have a product team of roughly 13 people, and we're able to just move so much faster on the product side. And that was really the reason why at the time it made sense to take that amount of capital for our business.
Okay, fantastic. Jordan?
Sure. So slightly similar story. So we had initially raised some money, seed, and we did that through a convertible note. And then we went to kick off probably very similar signals to you guys. With that initial investment that we brought in, we built the product, we validated the product with customers. And one of the big signals that we saw is very quickly all of our customers were converting, and not only, they were also growing. And so we started to kick off our first price round around June last year. Very interesting time to take an actual round to market. We felt as though we were in a position in the business that we needed to fuel growth. Our product needed to move faster. We needed more customer success people in the business because we were actually starting to phase launches because we couldn't keep up with the demand. So we were in this really interesting position where we took the round to market in June. As many people here and may have experienced before, the summer's not the best time to raise funds. August slows down a little bit. So that ended up closing just towards the end of September. And so that was probably about a 3.5 month period to do that round. But again, one word of caution would be summer things tend to slow down a little bit. But that was kind of the impetus behind that.
I'm like the only VC working in the city, which is why I'm up here. They have a lot of better choices, but by virtue of vacation, they got me. Okay, Corey, you're up, buddy.
All right. So our last round, we actually closed this year a little bit earlier in the end of February, beginning of March. We did a $17.5 million Series A round. Prior to the Series A, we had done a seed round of about $2 million and change, about 2014, 2015-ish. Can't remember. It all kind of blends together after a while, right? So what we knew we were doing well was we were getting massive banks. We work with banks in Canada like TD and Scotiabank. We work with banks in the UK like Royal Bank of Scotland, to convert. And these were massive deals. And if we wanted to add more of those types of deals or pull them through our pipeline, we were going to need a team that can provide the right level of service and the right quality of service that banks expect. So we needed to build out our team on the sales, go-to-market, and service side. We already were very sort of product heavy because you kind of need to meet bank SLAs, service level agreements, and other standards of informational privacy and security. So we already had that in place, but what we really needed was a strong go-to-market and delivery team. And so that capital has enabled us to really grow our presence and deliver with excellence in these new areas. In terms of the time it took to put it together, when you're pulling together a Series A, we kind of think of things, or at least I like to visualize, sort of like sausage making, right? You're trying to build a machine so that you can have a repeatable process by the time you come into your Series A. So really what you use capital for is to help accelerate your growth capital, to take your product market fit and then build a massive business around it. And so in order to do that, we need to have all those proof points in place, and that takes a while to run through the gamut of investor due diligence and finding the right fit for your business. So I'd say we kicked it off, the process in earnest at the beginning of October. We had term sheets in place in mid-November, and then we closed, again, end of February, beginning of March, after the holiday season took its toll on being able to stay productive on that financing front. So that's kind of the end-to-end process for us.
Okay, Jason?
Our last round was exactly a year ago, from about today, actually. We raised $14 million from a West Coast U.S. VC. Our first round was in 2011-ish. It was $2 million, so very similar to Corey here in terms of quantum. How long did it take?
Yeah.
I'd love to say that I could track this because it was, and I'd love to say that we maybe did a tour of the proverbial Sandhill Road pitches or whatever it is, but we really didn't. And there's maybe some things that are good for business that are unplanned. We didn't plan this round. We got to know the VC for over a year, and I had never visited their offices. For over a year, I guess they were coming up here, meeting with us, introduced us to some customers, came to our user conference, and added value in many different areas. And I guess what started this off was from term sheet to close about 30 days. So they presented a term sheet. They said, we want you to think about this because we wanted to raise probably 2018 or 2019. We're a sustainable company, didn't want to exactly do any unnatural growth things.
Yeah.
But that's what kicked it off. So, you're getting to know them, Tola Capital, and then it was 30 days from term sheet to close.
Well, that is remarkably fast for us funding that large. So congratulations, and congratulations to everybody on the panel who have capitalized their companies extraordinarily well, started to build businesses, and collectively have employed more than 400 people. So that's a remarkable feat. Now, just to get a sense of the people in the crowd, could you raise your hand if you're an entrepreneur and you've ever raised money before? Okay, so maybe a handful, about 10 people. And as you can see, of everybody here, I think you're the only one, Jason, that's raised money from a large U.S. institution. You, Corey, you've got angels from the U.S., right?
We have a micro, I guess.
Yeah.
Drew would be a micro VC, so small Series A check.
Okay, and Jordan and Mallory, you guys are mostly Canadian?
Mostly Canadian. Hyde Park out of Chicago
Right.
led our seed round, however.
So, out of curiosity, can you guys talk a little bit about, and hold no punches. None of us should get insulted that are VCs in the room, but talk to us a little bit about the difference between Canadian and U.S. VCs as you see them, and how different their approach is, and what types of questions they ask that are different than the way Canadians ask them.
I can kick things off.
Great.
So we've shared a number of conversations north and south of the border. I think one of my observations would be Canadian VCs, I believe, are a little bit more practical and patient. And I think in the conversation that we've shared with Canadian VCs, and to the same point, you build relationships, fundraising never really ends. You're constantly nurturing and you're constantly giving them updates on where you're at, where you're growing, and what you're trying to get to. And I think the biggest difference we've seen in the level of conversation is in the Canadian market, it's more tell us the metrics you're trying to hit and we'll sit and wait and watch. And I think in the conversations that we shared with some of the VCs in the US, and you guys can speak to this as well, is it's immediately more on sell us the bigger vision, tell us how you're going to become a $100 million company in 5 years. We don't really as much care about your metrics and where you're going to be in 6 months. You can't take your foot off the pedal. Like, you obviously need to continue to drive the business forward. But I think we as businesses and perhaps the investment community here are a little bit more risk averse. And I think that it's something that we need to fundamentally change. And I think we need to be a little bit more bullish with both how we grow businesses, but also how we fund them. And I think we're starting to see that's changing. The ecosystem here, I think, has changed in the last couple of years quite a lot. But that would be our observation.
Jason, you want to go ahead?
Sure, I would. Even though we did a U.S. round, I can't say I have this checklist of all these scorecards of all these VCs. I would say that because we didn't shop this thing, we didn't compare that much in our conversations though, over the years, and I'm sure you guys get all the calls from the U.S. and Canadian VCs. I think one of the approaches is that, and the reason why we spent a lot of time with our ultimate one partner that we went with, is they added their deep domain, very strong hypothesis, network was deep, could clearly see how they understood, at least from not a financial perspective, from a very deep operational perspective. Not to say that the Canadian VCs don't have that, actually. I'm just saying that what we found with the conversations was deep domain operating expertise, very strong technically, B2B, and that's what we were. And frankly, it's hey, we have a hypothesis. There's 20 players in your space. You're ranked here on our list. We're going to do something. We want to do something with you and it was very aggressive and specific.
And quite calculated, obviously,
very
right?
Calculated. And I know we're not looking for a term sheet, but you have a board meeting and we want you to at least entertain it. And as a board member and CEO, I guess, is fiduciary responsibility to at least say, okay, and whether or not, and that kicked off our whole process, because I remember the night of, we're okay, we got this thing now. Now what do we do? And the board meeting was that week. And in the board meeting, we're okay, well, this is an unplanned event. None of the board members knew that we were gonna, and they're we didn't know you were a shop, but no, we weren't. But now we have this, what are we gonna do? So, and the write-up was less of a term sheet, more of a proposal of this is what we think we should do together and why we should do it.
So and then from there, it did not take very long to come to final terms. So clearly, valuation wasn't a huge issue for you guys, or for them, or for you collectively, and it was the right thing to do for the business for growth. So that speaks well to it. I mean, we see Canadian and U.S. VCs doing business together all the time. We are somewhat unique in that we've got a thesis around mobile. That thesis has changed over time, but rest assured that if you come to talk to us about a business that is outside of the realm of anything from the sensor to the cloud, it's unlikely that A, we would be able to add any value, and B, that it would be a discussion that might end after 30 minutes with an unlikely, with the likely answer of no. So I think, from my perspective, and I still want to go through, get perspective from everybody else, but maybe add, a little footnote to that, which is, how important is it that a VC firm or your funder has perspective, depth, knowledge of the business that you're selling into? Or is it really more around structuring, if you're a B2B business, how to structure a B2B business? Or is it deep domain expertise? In other words, Mallory, are you looking for somebody who's got incredible deep domain expertise in how to build 50-story buildings?
So no. So the construction industry experience was never a must-have for us. And I think at the end of the day, when we were looking at financing, it was really just about increasing the probability of raising the amount of money that we needed in the shortest amount of time with the best partner that we could find for our business. And so when we were looking at the US-Canada question, at the end of the day, of the, say 10 of the players in Toronto, the chance that the timing of their fund and they're going to have a thesis that matches your business and you're going to get along with the partner and they're someone you want to work with for the next 7 years, it's just not a lot of people to kind of be working with as you're putting together a fundraising round. So at the end of the day, when we were going to the US and speaking with more partners there, it just really increased the overall number of opportunities we had to ensure that we had that perfect fit. And so we could increase the probability of getting the round closed quickly. And so the industry experience wasn't, a necessity for us. It was really more about, they know how to grow software companies. Sure, they might have some connections in that space, but ultimately they're just a partner that we want to be working with for the next 7 years. Because you spend a lot of time with them at the end of the day. So that was kind of the number one thing for us. And then just having the opportunity to speak to more people and not having to kind of make a decision with a Canadian VC just because we were in Canada.
A lot of my thoughts would echo Mallory. I think my chairman, the chairman of Sensible, usually says to me and everybody in the board, life is too short to work with assholes, right? And so when you bring a new investor onto your team, it's a new board member, you want to be able to get along with that person. You want to be able to work with them and have constructive conversations. It shouldn't be sort of a teacher-student relationship. It should be one, built on collaboration and trust. And so for me, it starts with people. I think in our case, we have investors with some domain expertise and some domain experience, so that helps. But I think more important, listen, they're not going to sell to you. They can sell for you. They can open up doors, but ultimately you've got to execute on your business. So every VC, no offense, Alex, likes to say that they're going to be able to open all the doors in the world, or they're going to be able to bring XYZ value. And most of the time, it's a sales pitch, right? Like they're selling you money. Like investors are salespeople. And so what you've really got to look at first and foremost is, do you want to, figuratively get in bed with this person for the next 5 to 10 years of your life? And I think that's where it starts with me. And then the next thing is talent, and how are we going to grow this business? It's about network to people that have been successful in roles that you need. Like, how do you find your next director of marketing, or how do you find your next VP of sales, or how do you find someone who can help you take a business from 5 million to 25 million, or someone who can, depending on the stage of company, take you from 50 to 100. And those are different skills and different sets of experiences in sports, and that's why people, I think, choose who to work with from a VC standpoint more than, say, industry expertise or domain expertise. It's really about, how are you going to help me as a partner, as an operator, grow my business? Because you know more about your business than I think anyone else on your board will.
Yeah, I would completely agree with you. And I think that if you're getting pitched by a VC who says to you, I can bring you all these customers, I would call those customers before I take the money, because the probability of that happening is slim to none. And those are the types of customers that will churn very quickly shortly after their first contract comes up for renewal. We like to say being first institutional money in will help you secure your first customer, and do our best to help you with our network. We'll help you hire a great complement of employees around you that'll help you scale your business. And we'll help you in minor ways with governance and you becoming a better executive. But at the end of the day, we're placing a bet on you guys. We're placing a bet secondarily, I think, on the market that you are operating in, and thirdly, on the product that you're delivering. And that's mostly because that product's going to change so much over time. If you look at the first iteration of the products that you brought to market to today, I guarantee you'd be like, wow, this thing looks completely different than what I first envisioned. So back on the topic of raising money, and if we could all just dig a little bit deeper for a moment, and I will admit that there have been investments that I've made that I've regretted, for sure. I want to know if there is, and we don't need to name names, I will not do that either. I want to know, was there ever a time when you woke up in the middle of the night, or you looked at your business partner in the face and you said, oh, fuck, why did we ever do this? Who wants to go first?
With the investment or the business?
No, the investment. The business, I'm sure you do that every day. No, it's the investment part, right? I think it's fair to be transparent with everyone here, to know what they're getting, know what you're going to get into when it comes time to raising money. VCs can be assholes sometimes, right? We have expectations, and we're not in there running the business every day. So, to be fair, sometimes we put unreasonable expectations on our CEOs. And so I know that can be hard on people. Anyways, go ahead.
So I'll speak from our experience. We thankfully have not yet entered into a partnership with a VC.
You should
I know that's
check out at AlexBaker74 on Twitter.
I'd say our biggest learning in the same way that when you're pitching a VC, you go through due diligence, the VCs dive into the business, they look at your numbers, they look at your growth, they look at your team, they look at the market, they come to a conclusion. That goes both ways. And I think one of the things that we've tried to do as we've started to look at the partners you figuratively want to get in bed with is you have to do your homework. I think you have to speak to the entrepreneurs that those VCs have invested in. You want to understand how they've helped. You want to understand how they behave in thick and thin, because you're going to get at a moment in a business where the sky is falling and you're in a tough spot, and you want to be able to rely on those partners to help guide you through that. And again, it's a partnership. So I think we've been fortunate. That being said, we've only raised 3.5 at this stage, so we have yet to get into the bigger leagues that you guys have. But I think our observation has been we've tried to do a very, very good job at the homework on the other side of it. And at least that, I would say it's actually allowed us to walk away from 2 opportunities that we were close to, because everything came out of the closet in terms of some things we've heard.
Thanks, Jordan. I would say, look, growth is unnatural. In some ways, it very much is. And I have said to many people in our company, there's 2 things that grow for the wrong reasons. One is tumors, and the other is companies. So if growth is a choice and you're gonna take money, come to your question, Alex, of when did we sort of have a look in the eye and say, oh yeah, what the hell did we do here? It was more because we had a plan and we were going to do this organically, and then it's okay, this is the unplanned. I remember having multiple all hands on company meetings saying, guys, are we all in it? Are we all committed? It's kind of like the Matrix moment of the red pill, blue pill. Are you going to take that plunge and commit to this growth, because there are going to be unnatural things that are going to have to happen? So it was more of a, I guess, internal alignment question of okay, we knew we were going to do this, but should we advance this now? And good news is that we had the opportunity. We saw we were not capitalizing on all the opportunities that we had, and we were not maybe serving all the markets we could. So that obviously ensued in a financing, but that was the challenge there, I think.
Look, it's tough. We had an entrepreneur come into our office a couple of weeks ago who told us that there was still the same $750,000 remaining in their bank account that they had raised 18 months ago, and that they were interested in raising some, quote, growth capital, $2 to $3 million. And my feedback legitimately was, I don't think you're ready to raise capital. And their response was, don't you think I've grown the business reasonably? I'm, cash flow break even some months, just dipping into negative territory. And my answer was, you haven't taken a risk on the $750K that was in your bank to begin with. So if we put 2 to 3 to work, I have no confidence that you're going to find great ways to spend it creatively. And you're going to be a little bit afraid to lose it. And look, we're all afraid to lose money, but geez, it happens all the time, right? It happens more times than not. Frankly, a portfolio of 50 or 60 companies, I don't think one of them is cash flow positive yet. And we're talking everything from $0, which is obvious that they wouldn't be cash flow positive, to $150 to $200 million businesses. This is, this is a crazy life.
That's a good thing. I just want to clarify.
It's a great thing, right? My own personal balance sheet reflects that of our portfolio companies. It's perfect.
Kind of on that cash flow positive topic. So one thing I've been trying to do is speak to a lot of people that work in more traditional business environments, so manufacturing or construction or things outside of tech. Because I think when you're in the tech ecosystem and you're talking to VCs all the time, it's really easy to think that that's the only option. And a lot of the time it is a great option. It's not to say that it's not, but there are other options out there. And maybe cash flow positive makes sense for your business. Maybe taking on debt makes sense for your business. And I was speaking to this one mentor we had, and she said, at the end of the day, no company goes down in history for the way they finance their company. It was about the product they had and how much their customers love them. And I think when you're really, really early in the business, you feel like you're always trying to catch up. You need the money, you need this. You're always playing catch up. And then at a certain point, you're like, do you know what? I have options. I can take money from this person. I can take money from that person. I can take debt. I can do this. And that's when you really are able to put that money to work, I think. And so all of this kind of tech VC talk, just think creatively and think outside of the bubble of tech, because I think there's like a lot of different ways that you can kind of look to finance the company. And, you know, that company, for instance, there's someone else that's going to be a great partner for them, which is awesome.
That's exactly right?
Yeah,
Somebody
for sure.
who has appetite for the type of risk that they were willing to take, 100% right.
Yeah, and so
We just weren't the right partner.
For sure. So it's not no for everyone. It's just not right for us. And that's a good thing for everyone, I think.
And Mallory, like, your point's very true. Like, there are other options. Before this, we did a few $1 million through SVB, a line of credit. You don't really use it, but it was there. And before that, I do think the best capital we've ever gotten, is the GVF fund. Have you heard of the GVF?
Tell us more.
The Girlfriend Venture Fund. It's when you're starting off and you're not paying yourself, and they're just supporting you because of their love, and you're just living at home, and they're just funding it's just non-diluted, and it's amazing. But in all seriousness, like, we all have gone through support networks, and there's alternatives to like a VC. And I'm making an extreme here to bookend this thing, but it's true.
Did that graduate to the WF?
That did actually.
Okay.
That did actually graduate.
And
Converted.
what 2 months of salary did you use to buy her engagement ring?
Yes.
We've got a question, by the way, several. Thank you all for submitting them. The first one is around valuation. And the question is specifically, the majority of your companies are in a niche market that is not crowded by competitors, except, of course, for the rewards industry. Sorry, Jordan, you got picked on here. How was valuation done if there were not many comparables? I would say, just to the person that wrote the question and the people that upvoted it, as a person that looks at valuations on a day-to-day basis, I could almost assure you that there are comparables for just about anything. And as VCs, we can be creative to make it work, both in our favor and out of our favor. But anyhow, if you guys could each speak to how valuations were, why don't we talk about this, the valuation discussions you had with your funders, and how they came to the multiple that they gave you on whatever metric it was.
So initially it felt very like arbitrary, just generally SaaS company, this is what we're seeing these days. When you are kind of like pre-revenue, there's not a whole lot to look at. Now it's much more of a multiple. So there's larger construction software companies that have been acquired in the past that had similar types of contracts to ours. And so we'd be able to use that multiple as a pretty clear comp. And I think the valuation question comes up all the time. And I would just say, when you're negotiating a term sheet and a financing round, there's so much more to look at. And so you really have to think, like, what are the crown jewels of this negotiation? And it goes far beyond valuation. It's control, it's, preemptive rights in the future. It's all these different things that can come into play. So it's easy to get caught up on the valuation, but look beyond that.
I think valuation, just to echo what Mallory said, I think valuation is in some of these things almost like a vanity thing, right? So you see things like this posted on TechCrunch and on Crunchbase, and people sort of equate valuation with success and ignoring any ratchets or as Mallory said, any protective provisions that may exist for the investor. It's really, you got to focus on value add and what you're actually getting out of the investor rather than any valuations. Because ultimately, if you get too high of a valuation and you can't actually grow your business to the next value inflection point, everyone's going to suffer a world of hurt if you go out and raise more money or the market looks to evaluate your progress. In terms of how in the past valuations have worked for our business, obviously it starts with, I think, looking at the progress of the business on the page, but then you can use comparables like what the market is looking at in financial services in our case, and also what the future potential value, like what is the outcome that an investor wants to get out of this deal. But I think when you just comes down to bringing the deal together, it's usually like 20, 25, 30% of the company is what they're gonna look for, depending on, and it'll be lower if you're kicking ass, and it'll be higher if you're not, right? And then based on how much money you're raising, I mean that's kind of what the valuation of the company ends up becoming. And if there's a deal there that looks too expensive for you, you're probably not going to do the deal. Or if they think you want the crazy valuation because you want the vanity number, then they'll start to attach a bunch of stuff in there that you're not going to like, and you're probably not going to do the deal. So my 2 cents is don't get hung up on valuation. Worry about whether taking the money, to Alex's point earlier, is the right thing for your business.
Any other point? By the way, you answered the second most upvoted question as well.
There's actually one thing. Oh, sorry, you go ahead. There's one thing that I learned when we did like the first VC round that it's so obvious now, but I had never really thought about it before. If you're raising a larger round, and Corey, you kind of alluded to this, it's easier to get a higher valuation because you now have more time to grow into that valuation. So, the same company could maybe get a $15 million valuation pre-money if they're raising $1 million, but if you decide to take on $5 million, you might get a $20 million pre-money. So that's kind of like one extra lever that seems to be there when you're negotiating that valuation, depending on how much you want to take.
I echo, I guess, most of what the panel is saying here. I'd say that one thing that did also attract us to accept the terms that we had was rather than targeting a percentage, like you're saying, like 20% or 30%, which some other venture capitalist firms would be like, at your scale, we were just under 100 people, so they're like, you gotta, we expect you to raise $20-30 million. And I frankly couldn't think of a way of efficiently deploying that.
Yeah.
So we were okay with raising, they were okay with raising a much smaller amount as well. And you're right. I think getting comparables is easy. I think they had that, but it's not only obviously just revenue. It's all the things you read about. It's about churn numbers and all that kind of stuff.
I think there is
much more.
By the way, I think there is something to be said about that and around efficiency of capital. And if you were to take $30 million into your business a year ago and you were only really prepared to spend 15 of it because you were already cash flow break, whatever your metrics are, I mean, there is something to be said for not wasting money. Right. And yes, comfort is important on one hand, but on the other hand, if you don't have a method to spend it, then it's probably not worth investing it. And on the investing side, there was a question also from the crowd that's been upvoted quite a bit around taking strategic money or money from customers. So just by way of hands, has anyone taken either strategic money or money from customers on the panel? And if you don't want to disclose it, then don't worry about it. Okay.
We've been offered it.
Yeah.
We haven't because who was offering it to us would try to limit who we could work with in a pretty big market.
Yeah, like every year someone asks us, one of our customers, and we've actually very politely, graciously said that it changes the dynamics that we don't want to have there.
Ditto.
Mallory, any of those hard hats come to you with some green?
A couple, but yeah, we don't normally take the conversations too far out of fear of kind of like alienating our other customers, essentially. So
I would say to the people that liked that question and the people that answered that question that early on, look, if you need capital and you're struggling to get capital and that's a source of capital, then by all means. But if you have some strong institutional players around the table with you, taking capital from a strategic or from a customer often has bad side effects, and particularly if they're not used to the roller coaster. Someone up here mentioned that it's a 7 to 10 year relationship, which is what it is. By the way, the average exit is sitting at like 9.4 or 9.5 years after the first institutional money in. They're like exit horizons are getting crazy elongated. At later stages, though, there are some very large corporations that are doing institutional investing that seem to have a sense of what they're doing. We've partnered with a number of them, and they do a good job sort of separating church and state. So I would say there is a time and a place for it, and if you do have the option of accepting it, then I think by the way, the venture community is pretty open as well, and there's great resources at places like Mars and through some of the accelerators, and there are people that you can ask about that and get some opinions on. But at the end of the day, if you need capital to grow your business and it's available, some people will do it at all costs, and others will be very stubborn about it. Let's see what else we've got here. Do VC firms look for companies they fund to have completed some sort of accelerator or incubator? Does that help in raising money? Mallory, you know what? Mallory and Corey, you guys both went through accelerators and or incubators. Jordan, I don't think you guys did. We did. You did. Okay. Talk a little bit about your experience with the different accelerators that you participated in and how helpful you felt they were to raising the next bit of financing.
So I don't prerequisite, no. I think that what it can do if you I think three of us, all of our companies went through the Ryerson Digital Media Zone. And I think that if you treat a space like that as a launching pad to help grow your business and build your network and maybe get introductions to first customers, that's going to be the experience that helps prepare you. But as hey, they've gone through these battles, they've been exposed to new ideas, they've been able to build their network as a result of being there, not a prerequisite. I think there are, you have 111, which isn't so much of an accelerator to me as a shared working space where you're exposed to other growing companies that may be a little bit further along than the types of companies you'd see at a DMZ. I think all of those things help harden you and help expose you to different experiences and different challenges that entrepreneurs are facing. The prerequisite, I think, is strong, but I would encourage it. I think it's a way to meet people, because I think the name of the game early on is to get to customers, find product market fit, and hire the best people you possibly can to add to your team.
Yeah, I'd say the way I build off it is through DMZ. First two customers came from it. Also, definitely helped us network within kind of the early stage investor community in Toronto. Helped us close our very first round. My one observation of that space is I often do find sometimes it shelters businesses from the realities of the real world. And so I think we support each other quite a lot. But I think once we actually moved out of there and got out and really started to run our business, it wasn't the rosy glasses all of the time. And I think inserting a little bit more reality into those experiences, I think would help. But for us, it was purely the network that we got the value from.
Yeah, super quickly, put us on the map for sure. The one thing that I noticed, sort of like words of caution, there's something to be said for getting in front of VCs too early. And when we finished the Next 36, like we had literally just finished university, had no business network in Toronto, had no idea what we were doing. We'd hear one speaker and then we'd do exactly what they said. We weren't really, the best at kind of filtering some of that information. And so I would argue even like when we first met Alex, like probably too soon. Like it probably would have been better had we had an extra year under our belt before kind of doing that first VC pitch. And I think the programs, like they do a really good job at sort of orchestrating a lot of those meetings. But I mean, I would argue that sometimes the company should probably just say, no, we're going to wait. And that's okay. So that's my 2 cents on that.
VCs don't have most of the answers, and they shouldn't contend to. And yes, people come through and we give people advice based on an hour conversation, and the last thing that they should do is go back and take that advice 100% for whatever it is, because they can go to the next person and next door over and they'll have a different piece of advice. And so I would just caution anybody that when you're getting advice from someone, take it for what it is. It's based on the conversation, the relationship that you built with them, and how deep that may or may not be, and that they don't have, that one person doesn't have all the answers, because if they did, they'd be doing exactly what you guys are doing. We have about a minute left. I think this is probably a good opportunity I want to go through each of the panelists now. I mean, you're all in growth mode. You've all raised money. You all have businesses that are accelerating very quickly. Why don't you tell the crowd what kind of jobs you guys are hiring for right now? Maybe there's some people out there that are looking, or maybe they know of people that are looking in some key areas. And so, why don't we start? Corey, we'll start with you. You always seem to be the last one to go.
Always. So I think number one, if you're building out your team, you're always looking for a steady pipeline of great product people, both on the development side and also on sort of the product management side. I think it's a skill that needs to be further developed in Canada, and so always looking for great ones. On the client services side, you're looking for people who can interface with large customers, so always looking for people there. On the marketing side, I've got two of our marketing specialists in the middle of the audience. They can wave, you can find them. We're looking for great people there, senior, junior, everyone in between to help.
He just said they're looking for great people in marketing. How do you two feel right now?
More great. More great. It's an important team. Find good marketing people.
Any of the three of you looking for two great marketing people? They're just right.
Pretty much the exact same on our
okay.
end. Tech, product, marketing, sales, 4 areas we're hiring for currently.
Okay, Jason, how about you?
Later on, this come to STEAMO, so I'm speaking thereafter, and we're doing a bit of a pitch for hiring. But people ops are head of talents here in the room. We're hiring in that. We're hiring in tech engineering, data science, customer success, virtually every group, sales as well.
Okay, and Mallory is the only Kitchener-Waterloo employer on the stage. What are
Took
you
me
guys
3
hiring
hours
for?
to get here today. So sales always, and then we're hiring a director of customer success right now. My co-founder is pregnant and going on mat leave in about a month. So time is of the essence, and she's been the interim manager for that team. So yeah, director of customer success, managing about a team of 4 people.
Okay, and just like lastly, we're out of time, but the best way to get then, if anyone here is interested in working at any of your companies, the best way to get in touch with the hiring manager or into the process is?
Website.
Okay. So they should.
Careers.
Nulogy Careers.
Okay.
You got it.
So do not tweet everybody, these people, your resumes, because it won't get through to the hiring manager.
I will not see it.
Okay. Listen, on behalf of myself and the rest of the crowd here, I want to thank you all and thank you to everybody at Techweek for what you guys have organized. It's important to get the community together and enjoy the rest of the evening.